Is the 2019 cash flow statement. Cash flow statements they're very different than everything else on the financial accounting side of things, in that they're not based around trading profit and loss accounts and balance sheets. So it's worthwhile having a good read through the notes on these, if you're coming at them for the first time or revising them for the first time in a while. Cash flow statements look at the movement of cash within a business. So businesses can be very profitable, but they can be over trading and run out of cash. And the cash flow statement is the accounting document that looks to make sure investors have the correct information of the cash business, or the cash element of their business. It's a legal document, so it's like if it's a published account, it's part of the published accounts. So you have to produce a cash flow statement, and it's this part here. There are three other documents that we have to do as part of the leaving cert question. Two of them which are part of the cash flow statement, and one is just sort of a working. So there's you'll see them in the question. They're called the cash flow statement, including the reconciliation statements. So you've got the first reconciliation statement, which is of operating profit to net cash inflow from operating activities, and you have the last one, which is of net cash to movement in debt. And we'll talk about all of those as we go. In the context of leaving cert question, there's a few tips and tricks in it. Really, with these, you have to start at the top with the abridged profit and loss account, and then finish with the reconciliation of net cash. So you have to sort of go in order of the documents to a point, because you can't really do, for instance, you can't do the reconciliation of operating profit to net cash inflow until you've done the abridged profit and loss account, and so on. You can't do the cash flow statement until you've done the reconciliation. And you can't do the reconciliation of net debt until you've done the cash flow statement. So there are things to be aware of. The next thing is that all of the questions are phrased slightly differently, especially around the context of fixed assets and depreciation. And you just have to take your time at them. So once they're laid out, they're actually not that difficult. So it's just a matter of trying to work out what you do. There are a couple of steps in the video just be aware of. I would be changing things on the question page that I won't be able to change on the question page in a video, but I'll just talk through what I'm doing there. So with these, really what I need to do, I need to look at these workings here. So what you're given is you're given two balance sheets. So you're given the balance sheet from last year and the balance sheet from this year, and basically cash flow statements are comparisons between the two. They look at movements in fixed assets, current assets, and so on. So you can see here, for instance, that fixed assets have gone from 550 up to 650, and we'll see what impact that has on cash. Stock has gone from 89 up to 107,500. We can check and see what impact that has on cash, and so on. But really, what we need to know, or what we need to do, is look at the workings at the bottom and see how they're going to impact on all of the numbers. So the first thing is this: the shares were issued at 120 per share on the 1st of the 1st, 2018. Now, all that's really saying is that there's a share premium of 20%. So that this 450 up to 510, in effect, that's 60,000, but you really sold them for 72. That's really all that's saying. So you don't need to do anything with that. That might just be a note on that for later on, maybe. So you can just make a note of that, and there's always one or two of them you don't really have to do anything with. Now the second one is sort of the big one. The big problems or the big difficulties of these questions are around fixed assets and depreciation. So we just take our time with this. So they will either in a question give you information about an asset that you've sold, or they will give you information about depreciation for the year, or they will give you information on the profit on the sale of fixed assets. And regardless of which, we're always trying to find out the same things. We're trying to find out what's happened to fixed assets that we bought. We're trying to find our total depreciation for the year, and we're trying to find our profit or loss on the sale of any asset that we've sold. So there's steps involved here. I'm going to do them on the page here. So fixed assets cost 70,000 and which total depreciation had been provided were sold for 41,300. So what I'm going to do, I'm going to look at my fixed assets from last year, and they're 550. But included in that 550 is the 70,000 of the asset that we sold. So if I was doing this in Leaving Cert, I would cross out that 550 and write 480 above it. See, I can't do that on my computer. So I'm just going to write fixed assets at cost from 2017, and they are 550, but they include the 70,000, so in effect they're 480, and that's going to be important for me for a little in a little bit. Okay. Second thing, I'm going to look at, it tells us the depreciation had been provided. Well, if we've sold the asset, we've also sold its depreciation. So the depreciation at cost, or the depreciation on 2017, is 80,000, but it also includes this 27,000. So I'm going to take that away. So that is 53,000. And then the next thing I'm always going to work out is the profit or loss on the sale of the asset. So the profit or loss on the sale of the asset, done in its normal way. So the value of the thing we sold was 70 minus 27, which is 43,000. We received 41,700. So therefore we made a loss of 1,300. Okay, so they're the important things there. Now, I'll come back to what you'll be using these numbers later on to work out depreciation for the year and purchase of fixed assets for the year, but I'll come back to them when I get to that. So that's number 2 done. I've changed my fixed assets at cost for the year, I've changed my depreciation from a cost from last year, and I've worked out my profit. Next one is debentures. So it tells us debentures were issued on the 30th of the 9th. So I'm going to just go up and look and see that. So debentures from last year were 80,000, and then there's debentures of another 40,000 issued, and that brings us up to 120. And it tells us they're 8% debentures. So I need to use that information to work out my debenture interest. So I'm going to do that. So my debenture interest, they're 8% debentures. We'll have a look at it, and we'll see that for the first 9 months of the year, we had 80,000 euros. So it's 8% of 80,000 by 9 months of the year. All right, and then for the remainder of the year, for the last 3 months of the year, we had 100,000 or 120,000. So, which is 2,400. Sorry, I shouldn't have. So it's 8% of 120,000 by 3/12. Okay, so the total debentures for the year then, the total debenture interest payable for the year is 7,200. And I'm going to use that later on as well. Okay, so that's important. That's dealt with. So if there's a change in the date when this happens, you obviously you have to work out your debenture interest around that. If it didn't tell you anything about it, you'd have to assume that you got the debentures at the start of the year. But it pretty much will always tell you the date you give you take out the extra loan on. Just a reminder, a debenture is just a loan. The total dividend paid for the year was 6 cents per share. So again, dividend paid. It's 6 cents per share. We'll go up and look at our shares. We've 510,000 shares this year. Remember, we're doing the accounts for this year, so it's always based around this year's figures we're working out. So it's 6% of 510,000. which is 13,600. Taxation for the year was 51,000. Now, really, you, you just need to make note of that. Okay, you wouldn't need to write it down in your question. You're going to use that later on elsewhere, but it tells you the tax charge on profits 51,000. We're just going to use that. Okay, fair if in our answer in our first part. The quoted investments give a return of 6% per annum. So that's investment income. Now it's 6% of whatever the investments are for the year. So the quoted investments are 40,000. Didn't tell you bought or sold investments during the year, so it's just 6% of 40,000, which is 2,400. So that's that done. Goodwill is to be written off over 6 years. So we'll just put that in. Over 6 years commencing in 2018. So the goodwill is 55,000. Sorry, it is 60. It's 66,000 and 55,000, so it's 11,000 of a difference. So they've that the difference between those two numbers is the depreciation. So it's just 11,000 euros. If it started off at 66,000 and it's divided by 6, that's the 11,000 euros. So that brings you down to the 55,000. So now you have all of the information needed to complete the question. So you don't really need any of this stuff down here anymore, except when we get to the depreciation, which we spoke about. So you're asked to prepare an abridged profit and loss account to ascertain the operating profit for the year. So the abridged profit and loss account is a published account from operating profit down to profit and loss balance. And what we have to do is work backwards. So we're trying to find out the operating profit. So this is going to be our answer here, a bit like incomplete records type B, where our final answer is the top. So we work backwards. Now we have all of this information here, every single bit of it. So we have enough to do it. So the profit and loss balance 31st of the 12th is this number here, 35,600. So that's given to us there in the balance sheet. And the profit and loss balance 1st of the 1st is the same line from last year, 42,250. Because if you ended last year with 42,250, you start this year with 42,250. So then to find the retained profit, it's what number plus 42,250 gives you 35,600. Because we know retained profit plus profit and loss balance equals profit and loss balance. So some number plus 42,250 is 35,600. So you're going to take them away from each other. So it's 35,600 minus 42,250, which is 6,650. So that makes sense. You made a loss of 6,650, which meant that the retained profit you had in your business of 42,250 goes down to 35,600. Dividends is next. Now, it told us the dividend paid for the year was 6 cents per share, so we worked that out. Dividends paid is 30,600. So we know dividends paid is a minus. So some number minus 30,600 is 6,650. So therefore, if you add back on the 30,600 to the 6,650, that'll give you the 23,950, which is the profit after tax for the year. So 23,950 minus 3,600 is 6,650. The taxation for the year, well, it gives us the taxation for the year as 51,000. I think I probably wrote it down here, did I? Yeah, taxation for the year is 51,000. So I'm going to put in that, and again, it's a minus. So again, some number minus 51,000 is 23,950. So we're just going to add them back on. 23,950 plus the 51,000 gives you 74,950. Then your last two, which debenture interest and investment income. Well, we did the debenture interest. we worked out that the debenture interest for the year is 7,200 and the investment interest is 2,400. So we take away debenture interest, so minus 7,200, and investment income is a plus. And then, of course, to work backwards, you're doing the opposite. So we're taking the 74,950, and we're going to add back on that 7,200 and take away the 2,400. And that gives you your operating profit of 79,950. So that's the first part done. So really all you need to know there is you're always doing the opposite. Obviously, if you know, you need to know your skeleton or your layout from there. Okay. So now the part B, the reconciliation of net profit or of operating profit to net cash inflow from operating activities. So the operating profit is 79,750. That's our answer from part 1. Now we have a load of things that to go in. So the reconciliation of operating profit to net cash inflow is used to find out the cash position for 1 year, because the 79,950 includes what are called non-cash expenses. So it includes depreciation, goodwill, profits, changes in bad debt provision, all things like that, which are non-cash items. So depreciation reduces your profit, but it doesn't actually reduce your cash position over the course of a year. So if your fixed assets go down in value, you just write them off as depreciation, but it doesn't, you don't have to write a check to anybody. So your profit goes down, but your cash position doesn't change. So you will always have more cash in your, or you should nearly always have more cash in your business than you have profit. So if we have an operating profit of 79,750, we can assume or we can hope that we would have more cash in our business than that. If we don't, we're not probably going too well. So the non-cash expenses, the four we're interested in really are depreciation, goodwill written off, which is depreciation, profit on the sale of buildings. If you buy a building for 100,000, it could be any fixed asset, but if you buy a building for 100,000 and sell it for 150,000, and you make a profit of 50,000, you don't get 50,000 into your business. You get 150,000 into your business. So you might bank the profit, but it's a non-cash. It's a non-cash earning. And the same with a bad debt provision. That's just an accounting term that we set aside money in our books. We don't actually do anything with it. So anyway, we need to know what these things are. So our depreciation charge for the year. Now, as I said, when I worked out my depreciation, or when I used my working one, I would have changed this number here from 80,000 to 53,000. So our depreciation charge for the year is the difference between the 53,000 that I'd have written here and the 125. So if we had an accumulated depreciation of 53,000 here and we have a 125 there, well then we must have had a depreciation charge for the year of 72,000. So it's the difference between these two numbers. Of course, that's the one I've changed. So you could, of course, on your workings page, you could have it written down there. You could do it straight away that if the depreciation last year is 53,000, well then the next line is that the depreciation charge for the year is 125 minus 53, which is 72,000. Now I told you depreciation is a non-cash expense, so we add back on our non-cash expenses. The same with the goodwill written off. We know the goodwill written off is, we worked it out and we wrote it down on our workings page, it's 11,000. Could also just be the difference between the two goodwill figures there. So again, goodwill written off is goodwill depreciated, so we're going to add that back on. Now the profit or the loss on the sale of the asset, I've got profit written down because it's from a different question. Buildings written down because it's from a different question. But we worked out the profit or the loss on the sale. So we worked out that we made a 1,300 loss. So it's loss on the sale of fixed assets. It's 1,300. Losses reduce our profits, but they do not reduce our cash position. So they're just accounting terms. So losses are like depreciations. So we're going to add that loss back on. And the next one then, the last non-cash expense is the change in provision for bad debts. So if provision for bad debt has gone from 1,200 up to 1,600, that's an increase in the bad debt provision of 400. So an increase in bad debt provision is like depreciation. It reduces your profits because it's an expense, but it's a non-cash expense. So it doesn't reduce your cash position. So an increase in bad debt provision of 1,200 up to 1,600 needs to get added on. So that €400 gets added on. All right. Then you've got the last three, which are our changes. We look at our stock, debtors, and creditors. Now, the reason we do that, it's to do with opening stock and closing stock, credit sales, and credit purchases. So our change in stock, if our closing stock was 89,000 last year and our closing stock is 107,500 this year, our stock has increased by, that'd be 18,500. So it's an increase in stock. So anytime I've got written change, it's either increase or decrease. So it's increase in stock. So think about that. If you increase the amount of stock in your business, well, you have to buy that stock. So if you've bought the stock, your stock goes up, your cash has to go down. Your stock can never go up and your cash goes up at the same time. If stock goes up, cash goes down. So an increase in stock of 18,500 reduces our cash. So that's going to be a minus 18,500. Debtors. So debtors are people who owe us money. So if last year debtors owed us 56,000 and this year debtors owe us 54,000, that means that we have €2,000 more in our business as a result of the change in debtors. So the decrease in debtors means an increase in cash. So if we'd 56,000 owed at the start of the year and we've 54,000 owed at the end of the year, well, they must have paid us off €2,000 over the course of the year. Creditors is our last one. And creditors, you look at the same process. Creditors are people we owe money to. So if at the start of the year we owed 72,000 and at the end of the year we owe 6,400, well, that means we've paid off €8,000 to our creditors. So a fall in creditors leads to a fall in cash. So our creditors going down is the opposite to our debtors going down. Debtors going down means we've received money. Our creditors going down means we've paid off money. And if we just do those sums, adding on our depreciation for the year because it's a non-cash expense, adding on our goodwill because it's a non-cash expense, adding on the loss in the sale of fixed assets because it's a non-cash expense, and adding on our increase in BDP because it's a non-cash expense. Taking away our increase in stock because if stock goes up, cash goes down. Adding on our decrease in debtors because if debtors goes down, that means people who owe us money have paid us off some money, and taking away our decrease in debtors because we've paid off some of our debt, decreasing our cash. That gives us then our net cash inflow from operating activities. Okay, and that's 139,950. Sorry. That should have been, just looking at the answer, sorry, we received 41.3. Otherwise this is going to be wrong. So that's 1,700 of a loss. I could have ignored that, but it would lead me to being wrong at the end and I won't balance then. So 143.50 is our final answer for that. So that's our reconciliation statement. And we take that 143.50 and we move it on into our cash flow statement over here. Now our cash flow statement is like a published account, so it has a very set layout with proper headings and all that. So you just have to learn it off. At ordinary level, they give you the headings. At higher level, they expect you to know the headings and everything that goes in it. So it's 140,350, and that's our net cash inflow from operating activities. Our heading then, our second heading is return on investment in service of finance. Now you get in your leaving cert, you get marks for all of the headings. And the two things that go in return on investment in servicing of finance should be fairly clear from the headings. Return on investment is investment income. Servicing of finance is debenture interest. Now, what we're interested in the cash flow statement is what we've paid, not what we're supposed to get paid, not what we're supposed to receive. It's what we've actually paid and actually received. So there's a process for these. The process is this. Now I'm just going to lay it out first. So it's last year's plus the charge or the profit and loss less this year's. And you'll see what I mean by that as we go. So what I mean by that last year's is the number from here. So the number from the balance sheet from last year. What I mean from the charge for the year is the number from over here. If it exists over here, from the profit and loss account, or from, yeah, it'll be from over here always, but it could be, it could also be given at the bottom of the question. And what I mean from this here, it's this number here in the current assets or current liabilities. So if we take our first one, which is investment income received. Last year, our investment income due is 1,800. So we're owed 1,800. Our charge for the year is what we worked out and put in our answer over here of 2,400. So we're supposed to get 2,400. We were owed 1,800 from last year. So if we've received everything we're supposed to get, that would be 4,200. But then at the end of the year, we're still due to get 2,100. So we haven't received that. So last year's what we're owed, plus this year what we're supposed to get, will give you what you should have got over the course of the year. And then if you take away what you're still owed, that'll give you the amount you actually did receive. So for investment income, you have received 2,100. Now, these are pluses. You've received 2,100. So we're going to put that there as a plus. For debenture interest, if we do the same thing, now I can just keep using the same little profile. I don't have to keep writing it out. For debenture interest, that'll be a current liability. We owed 2,000 euros at the start of last year, or at the end of last year. Our bill for the year is our answer from up here, 7,200. And then less this year, what do we owe at the end of the year? Well, we still owe 1,400. So if we paid off everything that we'd owed, our payment would be 9,200. But at the end of the year, we still owe 1,400. So we take that away. And that gives us the amount we actually have paid over the course of the year of 7,800. So we've paid off some of what was owed. So we were supposed to pay 7,200 this year, but we owed some at the start of the year. That brought us up to 9,200. We still owe some of it at the end of the year, 1,400 to take away, which means we must have paid 7,800. And if we've paid it, it's a minus. So those two together give you the 5,700 of a minus. You don't have to do the sum each time. You just leave them there as is. Okay, we're going to do the same with tax. So taxation is last year's figure. we owed 51,200. The charge for the year on taxation is 51,000. And that'll bring you up to 102,200. But at the end of the year, you still owe 55,000. So you take that away. And that will give you 47,200. And that gives us the amount we've paid. Now, some of the questions will say the taxation bill from last year was paid. And if that was the case, it would be 51,200. You would have paid, or the bill for the year must be whatever you owe. I'll show you that in one of the other questions when it's given, but that's the process. So it's 47,200 is the expense. So, or the amount we've paid. Of course, that's a minus because we pay tax. Now, the next one is the capital expenditure and financial investment. So we look at our fixed assets in this case. Have we received any money from selling fixed assets? Have we paid any money to acquire fixed assets? And pretty much you always do both. So have we received any money from selling fixed assets? If you go back to the very first working that we did, it says fixed assets which cost 70,000 and the total depreciation of 27,000 being provided were sold for 41,300. So we got 41,300 from selling a fixed asset. The payment to acquire fixed assets. If we then look at our fixed assets, remember what I said with this 550. On your question, you will have changed that down to 480. If this is now 480 and this is 650, well, then you must have bought fixed assets. You can already see if fixed assets have gone up, you must have bought fixed assets. But it's 550 minus the 70,000 brought down to 480. 480 up to 650 is 170,000. So you must have paid 170,000 if you were to go from 480 up to 650. Okay, so our overall position on those is that we've spent money on fixed assets. And we've spent 128,700. Our dividends paid, we're going to do the same thing with our dividends. We check here, dividends due is normally over here. So dividends paid from last year is 0. Our dividends due from last year is 0. Our dividends for the year are 30,600. And there's 0 due at the end of the year in creditors. So that means we must have paid 30,600. So I just want to, even though there's 2 zeros, there is no dividends there, and it's pretty straightforward. You can tell here dividends. Should say it here. Oh no, it doesn't. If there's nothing due, it doesn't mean you didn't pay them. Okay, so the 30,600 is the amount that you've paid. So that's a minus. So you then have a net, your answer is known as your net cash inflow or outflow at that point. So we do all the sums up to that point and you get a minus 71,850. So that's a net cash outflow in this situation. So cash has flown out of your business by 71,850 over the course of the year. Management of liquid resources. Now that looks at one thing only. It looks at the purchases or sale of government securities. Government security is government debt. So we have invested in government debt. So we have loaned the government money in reality. Prize bonds would be an example of government securities. You give the government your money, they give you your prize bonds, which you can cash back in at any time. So you do the same thing. You just compare last year to this year. So it's 0 up to 27,000 is 27,000. So we have bought government securities costing 27,000. So our cash position has gone down by 27,000. Okay, and the last thing is financing. Financing looks at our finance by. So you can have a repayment or an issue of debentures. A repayment of debentures is when debentures goes down. So if this went from 80 down to 40, that would be a repayment of debentures. An issue of debentures is when debentures go up. You've taken on more loans. So in this case, we have taken on a 40,000 loan. So if you take on 40,000 of a loan, your cash goes up. Our shares have gone up. They've gone from 450 up to 510, which is 60,000. And they actually went up by more than that because there was a share premium. If you remember, we got 20% extra on the 60,000. So 0 up to 12 is, or 20% of 60,000 is another 12,000 euros. So overall, our financing position went up. So our increase or decrease in cash is the answer from net cash outflow down as far as financing. So it's 13,150. It's a positive, so that's an increase in cash. So you can actually check to see how that's happened. I'll show you how to do that at the end, how you show what's happened to your cash. Actually, I'll do it now. So you can check that that answer is right by doing as follows. If we compare our cash, cash has gone from 850 up to 4,000. Which is, what's that, 3150. That's the first thing. What else is cash? Well, the only other thing that's cash is bank overdraft. So bank overdraft could be bank or bank overdraft. So just compare them. Your bank position in reality has gone from minus 25,000 to minus 15,000. So 25,000 to 15,000. In effect, your amount in the bank has gone up by 10,000. It's gone from minus 25 to minus 15. So add those together, you get 13,150, and that's your cash position, which equals the same there. Okay, the last thing is the movement in net debt. Now we start off with the cash flow, the change in cash, which is 13,150. Cash used to purchase liquid resources and cash received from the payment of debentures. So we're looking at two things. Liquid resources are government securities, and we're looking at debentures. If debentures goes up, our net debt has gone up. So if you take net debt as being a minus, right? Our net debt has gone from minus 80,000 to minus 120. So that's a minus 40,000 from the cash issued from the debentures. I don't want to get too bogged down in that, but it's gone from minus 80 to 120. Now, our loans then, so money we've loaned out, we have loaned the government 27,000. So our positives have gone from 0 to 27,000. So we are owed 27,000 by the government. We owe 120,000, or minus 80 to 120, which is an increase in our borrowings of minus 40,000. So that's the debentures are money we owe. So we've gone from minus 80 to minus 120, which is minus 40 in money we owe. In money that's owed to us has gone from 0 to 27,000, so plus 27. So our change in net debt is 13,150 minus 40 plus 27, which is 150 euros. Now our net debt then, I'll just have to do this as a working. Net debt is our debt position over the course of the year. So 1st of January, 31st of the 12th. So in effect, last year and this year. So let's look at our debt. How much debt did we have at the start of last year? Well, we had debentures. We had debentures of 80,000. And this year, our debentures are 120. Bank overdraft, that's debt. So last year, Our bank overdraft is 25,000. This year, our bank overdraft is 15,000. Okay. Our government securities and cash are the opposite, right? So our government securities are the opposites of our debt. So you can do those as, it doesn't really matter which you do as minuses and which you do as pluses. If you do the loans as minuses, you do the assets as pluses. If you do the loans as pluses, you do the assets as minuses. So that's the way I have it done in this case. So our government securities last year were 0. I don't know, it's right, 80,000 and so this should have been 25,000 here. And this should have been 15,000 here, sorry. Last year was 0. This year it's 15,000. So what it said, if you're doing these as pluses, you do the asset ones as minuses and vice versa. And the last thing, the opposite of bank overdraft is cash or bank, depending on what you have. Our cash was 850 last year. Again, that's going to be a minus. And our cash this year is 4,000. So that's a minus there. So if we just check those sums, we've 104, 150. And for the other one, we've 116. That doesn't seem right. 120. And 15 is 135. Government security should have been 27,000 there, sorry. And 4,000, yeah. So then we look at that. Our net debt on the 1st to the 1st is 104, 150. Put it in as a minus. And then at the end of the year, it's 104,000. So you've got 104, 150 as a minus. You have a change in net debt of 150. So plus 150 minus 104, 150 is minus 104. And those numbers equal up. Okay, so that's your cash flow statement. I'm going to put up quite a few of these over the next few days because they're all just slightly different. They're to me, they're one of the more straightforward questions. They're quite quick. Just be aware you will always be asked a good bit of theory on them because they're quite quick to do. So the theory will be associated with cash flow statement. So explain what is meant by a non-cash item. So non-cash item is something that affects the profit and loss account but does not affect your cash balance. So the examples of non-cash items are depreciation, change in bad debt provision, bad debt written off, or bad debt, change in bad debt provision, goodwill written off. So there's examples for you. Explain 2 items that affect cash but not profits. Well, a loan received increases your cash but doesn't affect your profit. An investment purchased reduces your cash but doesn't affect your profit. Purchase of a building reduces your cash but doesn't affect your profit. So anything that's based around assets or liabilities changes cash but doesn't affect profit. So hopefully they're of some use to you. All right, lads, that's that one done. We'll hopefully see some of the other ones over the next one.